Hello everyone, once again welcome to my channel. In this video, I will try to revise the unit 2 of our FM subject. Unit 2 is all about financing decisions. This entire unit is divided in four different parts, okay, for the easy understanding purpose. So let me start the first part. Here, first part means sources of finance. Basically, we have four different sources of finance: equity shares, preference shares, debt capital, and internal sources. Let me explain one by one. Your capital, specifically equity capital. So, equity capital represent the owners' capital because equity shareholders are the owners of the capital, owners of the company. Why they are called owners of the company? Because they are bearing the risk. They are bearing the risk for the companies and there is a profit, okay, then and then they will get the dividend. There is no profit, it means no return to equity shareholders. That's why they are known as the owner of the company, and the capital is known as owner's capital. One more thing, the liabilities of the each equity shareholder is limited to that number of shares. If I have two shares of one particular company, my liability is limited to that only particular one share. One more thing that you need to remember here, okay, that equity capital is most expensive source of finance as compared to preference debt and internal sources. It is more risky and more expensive source of finance. And for getting the equity shares, company need to go for the IPO or FPO, initial public offer or following public offer. These two are the process that company need to follow to issue the equity capital in the market. We have some types of capitals. Authorized capital means the amount of capital that company can potentially issue, the maximum amount of money that company can issue, that is called as authorized capital. Out of that authorized capital, whatever the amount is offered by the company to the investors, okay, amount offered to the investor, that is called as issued capital. And whatever the amount is subscribed by the investor, that is known as subscribed capital. Moving ahead, paid up capital, actual amount paid by the investors, that called as a paid up capital. Generally the issued capital, subscribed capital, and paid up capitals are same. Okay, values of the shares. Par value means a value recorded in the memorandum of association. Issue value, at which the equity shares are offered, issued. And book value means a recorded value of equity shares in the books of the company. And market value means the share price of that particular companies. So four values are there. Par value, generally we have 100 rupees. Issue value, maybe with discount, maybe with premium. Book value, value recorded in the in the books of the company. And market value, the current value, present value of the shares. Okay, now this is important for equity shareholders. The rights of the equity shareholders. Number one, right to income. Here, right to income means right to get the dividend from the company. Right to control, it means they have voting rights and they can elect the board of directors. Pre-emptive rights, okay, pre-emptive right means they have a right to purchase the additional shares of the companies, and they have a right shares. Whenever the company go for the additional issue of the shares, first right is given to existing shareholders. Next one, right in a liquidation. Actually, in a liquidation, equity shareholders does not have any right. They get the money at the last. After paying all the debt, after paying amount to preference shareholders, if any surplus amount is there at a time of liquidation, it is paid to equity shareholders. But in general case, equity shareholders are not getting anything in case of liquidation. Advantages, limitations, I am living. Okay, you can read because these are the easy points. Next we have preference capital. Your preference capital, why they are called a preference? Because they have a preference in two different ways. First, they have a preference for the dividend. Whenever the company declares the dividend, first dividend paid to preference shareholders, and second, at a time of liquidation, the first repayment of money is goes to preference shareholders. That's why they called preference shares or a preference capital. As compared to equity capital, it is less expensive, but as compared to debt, it is more expensive. And here we have some types of preferences. Cumulative, in which the dividend is cumulative every year. Okay, it is transferred or carried forward to the next year. Non-cumulative case preferences, in it means if there is profit, if there is dividend, company declare the dividend. If no dividend, it means it is not carried forward for the next year. Participative preferences, they have a right to participate in the meetings of the company. Non-participative does not have a right to participate in the decision making process of the company. Redeemable, those are redeemed after 5 years, 10 years. Irredeemable, once it is issued, it is remained with the company for a lifelong. Convertible preferences, those may be converted in debentures and equity shares after a particular time. And non-convertible, it means it's remain a preferences as preferences for the lifetime of the company. These 8 types of preferences are there. Please remember. Then after advantages, limitations, I am leaving to you. Number third is debt capital. Generally, in a debt capital, we have two debentures and long-term loans. Debenture is an alternative option to a loan. Okay. One more thing, it is less expensive source of finance as compared to equity and as compared to preferences. And here more flexibility is there. Company can decide the interest rate, company can decide the principal amount, company can decide the time period also. In debentures also we have same types of debentures as we have preferences. Okay, different types of preferences. Here we have convertible debentures, non-convertible debentures, secure debenture, unsecured debentures, uh, then convertible debentures, non-convertible debentures, like this. Okay, features of debenture, it is trustee, security, interest rate, maturity, and convertibility. These are the features. Term loan, generally we have two types of loan, long-term loans and short-term loan. Long-term loans generally more than 1 year but less than 10 years, and short-term loans means less than 1 year. And these loans are offered by the private bank, public bank, and financial institutes. And in internal sources, we have two different sources, retained earning and depreciation. Retained earning is the part of profit that company reinvest in the business. Suppose company has earned a profit of 5 lakh rupees. Out of that 5 lakh rupees, company declare the dividend for 2 lakh rupees. So remain 3 lakh. That is considered as retained earning that company will invest in the business for the growth and expansion. Now next one, depreciation. Here depreciation is non-cash expense. So every year whatever the amount is depreciation, whatever the amount is a charge as a depreciation, that is with the company, that is not paid to anyone else. So that is used for the purchase of new machinery, or that is used for the capital expenditures. So these are the two different sources. Again I repeat, equity shares, preference shares, debt. In a debt, we have debentures and loans, and internal sources, retained earning and depreciation. With this, our first part of Unit 2 is over. Now the second part, and that second part is capital structure. Okay, let me share that part. Here, capital structure means a mixture of different sources of finance. Capital structure means a mixture of different sources of finance. Generally, we can call that capital structure refer to relation between the various long-term sources of finance, such as equities, preference, and debt capital. Okay. Capital structure in an equation we can write like this: capital structure is equal to total assets minus current liabilities, or else capital structure is equal to uh, share capital plus reserve and surplus and plus non-current liabilities. Optimum capital structure, a capital structure in which the market value of the company is maximum and overall cost of the capital is minimum. We have understood this capital structure and optimum capital structure with the help of example of T. Okay, how we can make a T and which T will give you the maximum benefit like this. Then after forms of capital structure, in some of company you will find only equities, in some of company you will find equity and preference, in some of company you will find equity and debentures, and in some of companies you will find equity, preference and debentures. Right now, all the companies generally having this type of forms of capital structure, equity, preference and debt. Now moving ahead, determinant of capital structure. First determinant is financial leverage. Second one is growth and stability in sales. If the company having the same amount of sales every year, company go for the uh, high level of debt, and if sell is not stable, company go for the equity. Cost of capital. Okay, cost of capital, cost of equity is high, cost of preference is low, medium, and cost of debt is cheapest, minimum cost. Cash flow ability, if the cash flow remains same, company go for more debt. If the cash flow is not remain constant, company go for the equity. Nature and size of the company, generally public companies are employing more debt and small companies are employing equity. Control, if the company does not want to alter the control of the company, company go for the debt. And if the company is not concerned about the control of the company, company go for the equity shares. Flexibility, generally debt capital are more flexible. Requirement of investor, company need to fulfill the requirement of private institutes and uh, financial institutes. Capital market conditions, in a depressed period, okay, company go for the more debt, and a boom period company go for equity shares. Asset structure, if the company have some assets on which company can get a loan, company go for the debt. If the company does not have that much of assets, company go for equity. Period of finance, generally for 7 years or 5 years, we are issuing companies are issuing debentures, and for permanent requirement, company issuing equity capital. If you remember, I have taken example that equity shares are generally known as, I consider as a wife, okay, and debentures and debts and preferences are as girlfriend because they are for short term, whereas equity shares are for long term. Purpose of finance, if company wants a capital or a fund for short period, company go for the debt. If the company wants a finance for a long period, company go for equities and other sources of finance. Cost of flotation in equity is very high, in a debt it is zero. We have taken example of credit card. Personal consideration and corporate tax rule, risk and competition. Total 17 points are there. You need to remember only 8 points in an examination. Then after next, theories of capital structure. These four theories are there. The first theory, that is net income theory. That theory is given by David Durant, and according to this theory, capital structure is relevant to valuation of the firm. It means changes in the capital structure will change the value of the firm. And according to this theory, this approach, please remember this is the heart of this theory. If company use more debt, the overall cost of capital is reduced and company value will increase like this. Okay, as company use more debt, overall cost of capital RA will reduce. Okay, and as overall cash cost of capital reduce, the value of the company will decline. Assumptions are there. Please remember these assumptions. Already we have discussed this in detail in the class. So I'm not going for the detailed explanation. Just you need to remember this. Okay. No corporate tax rule. Cost of debt is less than cost of equity. Company use the debt and it does not change the risk perception. That means risk remains same. No corporate tax. Total capital requirement remains same. KD and KE remains same. You need to draw the same diagram in the answer if the question having 8 marks. Okay, and this is the formula. Ra is equal to RD d upon d plus E plus Re d upon d plus E, or else V is equal to E plus D. Now second, so here in a first is only one thing that you need to remember. According to NI approach, if company use more debt capital, overall cost of capital will reduce and increase the value of the firm. Now the second one, that is net operating income, that again suggested by or presented by David Durant, and it is opposite to the previous. According to this net operating income, the capital structure is irrelevant to the value of the firm. It means if you change the capital structure, if you change the equity, debt, debentures, preference, it does not affect the value of the firm. And now the heart of this theory is the change in capital structure will not lead to any change in total value of the firm or market price of the shares as well as the overall cost of capital. Let me explain with this diagram. As a company use more debt capital, the equity shareholders are demanding more return. Okay, and as they are demanding more return, cost of equity capital will increase as company use more debt. But RA, overall cost of capital remains same. As overall cost of capital remains same, company value remains same. Again we have 5 to 6 suggestions here. Overall cost of capital remains same, no corporate tax, KD and K or remains same. Okay, total earning remains same, and use of more debt does not change the risk perception of the shareholders. Formula. Okay, please remember this formula. And now the third concept, please here remember the short form and full form both. Stand for Modigliani and Miller, and this approach is presented by both in 1958. And again it is irrelevant theory of capital structure. Okay, it means if the capital structure change, that does not affect the market value of the firm, because here we have perfect capital market. And according to this approach, please remember nothing which may be called optimum capital structure. So according to theory, capital structure does not, sorry, optimum capital structure does not exist. Okay, these are the assumptions. Perfect capital market, no return earning, no corporate tax, investors are rational and 100% dividend, and risk remains same. Now this is very very important for because that may be asked in 8-mark question. So please remember here. According to this we have two firms. If you remember, we have taken example of XYZ and ABC company. Okay, they are similar. Both the firms are similar in respect of all the criteria, but except their financial profit. In XYZ company, we have equity and debt. Okay, in ABC company, we have equity, debt, and preference. Now, the company having a undervalued, okay, company having undervalued their market, that, wait for a minute. If companies shares are overvalued, then investors are tendency to sell it. If the XYZ company is having overvalued share, investors are sell the shares of the XYZ. And if ABC company having undervalued share, then investors have purchased the shares of the undervalued company. So according to this, okay, suppose the market value is 50, okay, and shares price of the XYZ is 30, whereas share price of ABC is 70. So investors will sell the shares of the ABC. Okay, continuously they are selling, because as company shares are sold, their price will reduce from 70 to 50, and investors are buy the shares of XYZ because it's having undervalued 30. So 30 to 50, up to the 50 they are buying. So किसी एक कंपनी के शेयर्स सेल होंगे तो दूसरी कंपनी के परचेज होंगे. That process remain continue until they both the companies are getting settled. So this is the concept of MM. Okay, this is the formula, and this is the diagram that you need to represent. And this traditional approach, the fourth approach, is a mix of NOI and NI, net income and net operating income. That's why it is also known as intermediate approach. And according to this approach, the mix of debt and equity capital increase the value of the firm by reducing the overall cost of capital up to a certain level of point. Okay, up to rupees 5 lakh, it is reduce the company's capital, cost of capital, it will increase the value of the firm. But if company use more than 5 lakh rupees of debt, it does not work. It means now the value of the firm will decline. Now moving ahead. These are the assumptions. That's all. So these are the four different theories of capital structure. Please remember net income, net operating income, MM, and traditional. These four theories, determinants or factor affecting to capital structure, and the concept of capital structure. With this, our second point is also covered, and now we are moving for the next one, and that next one is cost of capital. We have done this entire cost of capital with a Google Sheet, so let me share that one. Okay, your cost of capital with first method. Huh. Before going for these discussions, let me revise that. Here we need to calculate the cost of equity, cost of preference, and cost of debt. For calculating cost of equity, we have different five methods. The first method is dividend approach method. And according to this method, the formula is KE, cost of equity capital is equal to D upon NP or PZ. We have calculated this one. Okay. Then after the second method, is there that represent the dividend price plus growth approach, in which we need to add additional G. Okay, K is equal to D upon NP plus G. Please remember, whenever we have a dividend plus growth in dividend, these two words are there. Okay, at that time you need to use this formula: equity shares, dividend, and growth in dividend. These three words are there. You need to use this formula and put the values. D stand for dividend, NP stand for net profit. Okay, generally issue price minus discount. If you have premium, then plus premium minus issue expenses. And G stand for growth. Then after next we have discussed uh, earning price approach, E upon NP. It is very simple. Okay, but this is not important for all of you. The first and second both are important. This bond yield plus risk premium again is not important for practical questions. This fourth one is CAPM, that is very important for practical questions. CAPM stands for capital asset pricing model, and this is depend upon two different components: risk-free return and premium for additional risk. And formula is KA is equal to RF plus BF in bracket RM minus RF. Your RF stand for risk-free return, BF stand for beta factor, RM stand for market return, RM stand for market return, and RF stand for risk-free return. Please remember these two methods, CAPM and dividend approach or dividend approach plus growth. Moving for the next one. Next we have KP, cost of preference capital. In the cost of preference capital, we have two types of calculation. Number one, calculation of preference shares. If irredeemable preference shares are there, KP is equal to DP upon NP. Okay, but if the redeemable preference shares are there, you need to use this formula: DP plus P minus NP upon N upon P plus NP upon 2. We have done this practical questions. Here DP stand for dividend on preferences, RP means redeemable value, okay, NP means net profit. Here students are generally confusing in NP and RP, so let me explain this one here. whenever this amount is given to you, okay, generally NPs we have 100. If the discount premium is there, we need to add or deduct. But whenever in a practical question, redeemable word, okay, redeemable word is there, and after that, whatever we have, whether it is premium or whether it is discount, that affect to RP, okay, that affect to RP, and whatever we have at a time of issue, okay, issue के साथ जो भी है, whether it is discount or premium, we need to adjust with the NP, and if redeem or redeemable and premium or discount, it is affected to RP. Issue expense is already given to you. If it is given to you, okay, it is not given to you, it is zero. Second, we have done the calculation of redeemable cost of debt, okay, issued at a par, premium, and discount. And this one is important, this is not important. Directly we will go for this. This one is important. Similar to redeemable preferences, but additionally 1 minus T is there. Please remember, whenever in a practical question you will find redeemable debentures, okay, and at the time of issue it is discount, it is applicable to NP, redeemable after 8 years, okay, and if premium discount is there, it is applicable to RP. So redeemable वर्ड के बाद प्रीमियम डिस्काउंट आए तो वो आरपी के साथ प्लस माइनस होगा, इश्यू वर्ड के साथ अगर प्रीमियम डिस्काउंट आए तो वो एनपी में प्लस माइनस होगा. Okay, that's all. This is all from my side about the cost of equity shares, cost of preference shares, cost of debt, specifically cost of debentures. Remaining 2 points are there: leverage and weighted average cost of capital. Let me share the leverage slide to you. When a company use, okay, when a company use fixed return funds or capital in the capital structure, at that time we can say company have leverage. So leverage means employment or a use of fixed return, fixed cost funds, okay, fixed return or fixed cost fund in the capital structure of the company. Mainly, we have three types of leverage: financial leverage, operating leverage, and combined leverage. Operating leverage represents the relation between the uh, ABIT and contribution. Okay? ABIT stands for operating profit and contribution stands for C. So, operating leverage is a relation between operating profit and contribution. Degree of operating leverage means converting the operating leverage in a percentage. So percentage change in a profit upon percentage change in sales, you will get the degree of operating leverage. Financial leverage, it's represent the relation between EBIT and operating profit. Okay, sorry, operating profit and PBT, EBIT and PBT. And last one, combined leverage, composite leverage, total leverage. It's a relation between or a multiplication of or a sum total of financial leverage and operating leverage. So these three leverages are there. Please remember the concept only. That may be asked in a 1 mark or 2 mark or 4 mark question. In mid one, we does not have a practical question from the leverage, but maybe there is in a final examination. And last one, weighted average cost of capital is there. Okay, please remember that concept. I'm not sharing that particular slides to you because this all is very easy. Please remember the short form: weighted average cost of capital. It is stand for WSEC. And one or two questions we have done. with this WSEC. So please refer that recorded sessions of that particular videos. So here in this video, I have covered sources of finance, cost of capital, capital structure, and leverage. I hope so. These videos will helpful for the preparation of mid examination as well for final examinations. Thank you so much for always watching and stay connected with me for more sessions regarding the financial management. Thank you.